Welcome to today's session on fundamental analysis for our final webinar of the month. It's fantastic to see some regular names here. Great to have you back with us. Also, a warm welcome to any, excuse me, any newer names. So I take it I'm coming across loud and clear. So what I mean is the audio is nice and clear and the welcome slide is visible. As usual, any issues, fire me a message and I'll see if we can do something from this end to improve the situation. So January's webinars have have largely been directed at newer traders, those who are just, shall we say, dipping their toes into the wonderful world of trading and investing. I know and remember well the feeling of being overwhelmed, unsure of where to begin study, given there are so many educators out there recommending one way over another. So what FP Markets is doing with the research team is, alongside creating an FP Academy, is also putting forward structured webinars such as this one today, starting with beginner subjects and gradually through the year progressing to more advanced concepts. As an aside, excuse me, sorry about this. As an aside, any suggestions on webinar themes that you'd like the team to cover here, please feel free to email the research team here at Markets Analyst at fpmarkets.com. Finally, those interested in a recording of the presentation, FP Markets do send an email to attendees shortly after the presentation concludes. However, the webinar will be available on the FP Markets main website under resources, and you can also view the webinars via FP Markets YouTube channel. Okay, so just quickly bear with me while I run through the disclaimer on screen. So the information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. FP Markets has made every effort to ensure the accuracy of the information as at the date of publication. Look, guys, I'm not going to read through this whole passage. I'm pretty sure you get the idea. This is not a presentation where I'm going to give investment advice. This is solely an educational presentation. So, for those who are unaware, who's behind the mic, for those that have been to previous presentations, just bear with me here. So as you can see, my name's Aaron Hill, and I'm the market analyst for FP Markets. I have more than 11 years trading experience. I also have the CMT levels 1, 2, and 3. I recently passed the CMT level 3, so I'm very happy about that. I also received the CFTe qualification in 2020. Now, as I've briefly touched on, I'm the technical analyst for FP Markets and have been for the past year and a half now. And as you can see, I also specialize in price action, Fibonacci concepts, the relative strength index, and chart psychology. Now, for most of you that know of me will know I am primarily a technical based trader, and I emphasize the word but, I have become increasingly passionate about the fundamental side of trading over the recent years, and is something I would encourage all technical analysts to research, even if you are consistently a consistently profitable technician, as we all ultimately are looking to grow as traders in this never-ending learning curve of trading. So just to be clear, traders, this is a presentation designed for newer traders and investors. So for those with a few years of experience, this may feel somewhat simplistic, so please do bear with me. Now, the history of fundamental analysis began with a gentleman named Benjamin Graham in, I believe, if my memory serves me correct, in 1928. And this was, of course, popularized by Warren Buffett, his mentee. Buffett actually says this about Benjamin Graham's book, The Intelligent Investor. I'm sure some of you do own this. And what he goes on to say is, this is by far, The Intelligent Investor is by far the best book on investing ever written. So I actually do own this book. It's a heavy read, and not one that I have yet to complete. Anyone that has this book will surely agree with that. It's a heavy read. So the definition of fundamental analysis, or FA, is a method we as traders and investors can use to measure a security's intrinsic value, looking at economic, social, and political factors. When I say a security's intrinsic value, I am referring largely to equities and options here. So just briefly then, in share trading or share dealing, intrinsic value can mean the true value, the true value of a company you're analyzing. Of course, like in technical analysis, we're all different, right? So we're all different and approach the market in slightly different ways. To assess the true value of a company, some may, for example, zero in on growth data for the company. Now, in the options market, intrinsic value is the difference between the underlying assets price and the options strike price. Now, through fear of confusing newer traders here, I will leave you with this regarding options. Intrinsic value is the value any given option would have if exercised today, right now. So with a call option, you can find the intrinsic value by simply taking the underlying assets price and minusing this by the call's strike price. And quite simply, with a put option, it's the reverse: the put strike price minus by the underlying assets price. Unlike equities, so foreign exchange trading and investing is unique. Working with what's known as currency pairs, so two currencies are paired together and quoted through what's known as a base and a quote currency. Just bear with me. So the euro in bear with me. Let me just. The euro in US, the USD current euro USD currency pair is, oh God, excuse my, I'm using the mouse, so you have to excuse my handwriting. The euro in the euro USD currency pair is the base currency, and always represents just one unit. The USD is the second currency, and that's known as either the quote currency or secondary currency, or sometimes even referred to as the counter currency. And this essentially provides provides the value of the euro, so the value of euro in USD. So fundamental analysis studies the economic developments of a country, events which can influence the supply and demand of exchange rates of their respective. So the supply and demand of their. So let me just repeat that again. So fundamental analysis it essentially looks at the development of a country, events which can simply be influenced by the supply and demand of their respective exchange rates, either positively, of course, or negatively. Analysts employing fundamental analysis tend to approach markets using what's known as a macro-driven theme. So macro analysis or top-down approach focuses on broad economic influences. This involves a comprehensive assessment of the economy, evaluating central bank policy and aspects such as the economic indicators. So think interest rates, growth data, inflation data. Then we have micro analysis. I'm not going to go into detail. All that is simply a bottom-up approach, and it's essentially the mirror opposite to the macro theme. So fundamental analysis is composed of three core elements. So we have central bank policies, economic indicators, and finally geopolitical events. These three components working in harmony. We should witness clear trending markets and should present opportunity to trade. So if one of these areas are in disarray or disorder, this can cause an issue, making it more difficult to interpret a clearer fundamental picture. So fundamental analysis essentially informs traders and investors why the market advances or declines, and provides you with a trade decision. So it would either be a buy, sell, or simply to trade flat. Fundamental drivers effectively highlight currency direction. A country's central bank is charged with the duty of banking regulation and implementation of monetary and fiscal policies. I know that's a bit of a mouthful. So look, well-known central banks are the United States Federal Reserve, or sometimes referred to as the Fed, the European Central Bank, or ECB, the Bank of England, or the BOE, the Bank of Japan, or the BOJ, and the Reserve Bank of Australia, often referred to as the RBA. The key component is that everything begins with the central bank and how they assess the economic data. So traders and investors attempt to anticipate the central bank's actions through evaluating economic indicators and reacting to the outcomes from the forecast, so the actual versus variance. The market projects, so what happens is the market projects the forecast for an economic indicator and subsequently reacts to the actual figure. Ultimately, high probability trading opportunities present themselves when economic data harmonizes with the central bank's sentiment. So this, coupled with a technical approach, provides traders with an overall trading picture to work with. So major central banks meet every 4 to 6 weeks. The Fed and the BOE, the Bank of England, are scheduled to meet every 6 weeks. So that's approximately 8 times each year. While the RBA, the Reserve Bank of Australia, meets 11 times each year. So trends or market direction is derived from the central banks. Therefore, it's crucial market participants, that would be us traders and investors, recognize how these meetings operate and understand the language they put forward. So just quickly, central bank governors, as you can see here, sit at the top of the central bank ladder. So when they speak, you must listen, as these individuals are the ones delivering these statements following interest rate decisions. So the head of the US Federal Reserve currently is Jerome H. Powell. The Bank of England is headed by Andrew Bailey, and the Reserve Bank of Australia currently has Philip Lowe at the top of the ladder. So central banks, why are they important? Central banks reorganize sentiment at each meeting. Members discuss the overall economic conditions over the past month and assess through a number of guides where interest rates should whether interest rates should be changed. So a country's central bank raising interest rates can be categorized as by way of a hawkish bias. What they're essentially doing here is talking up the prospect of increasing interest rates. So the prospect of cutting rates is also an option on the table for central banks, and that's emphasizing a dovish bias. Excuse me. So either a hawkish or dovish tone can translate into some very, very big moves being seen in financial markets. Now, if economic conditions remain unchanged, so the central bank is likely to then adopt what's known as a neutral stance, so there'll be no bias. Usually the central bank is accompanied by a statement and, of course, the interest rate decision. These are critical to understand. So the statement is the primary avenue employed to communicate with investors regarding monetary policy. So at its most basic, and I should have really touched on this before, but monetary policy are the actions undertaken by central banks, and such as altering the reserve requirement, quantitative easing, and raising or cutting interest rates. So let me just repeat part of this, so we're all on the same path. So the statement is the primary method used to communicate their actions with investors regarding, obviously, monetary policy, and the outcome of the vote on interest rates alongside other policy measures and economic commentary. So in addition, here you will find the central bank's forward projections. A week or so later, you can also view what's known as the minutes, and this is a more comprehensive analysis of the statement, because if you look at the statement, I think it's only, if memory serves me, it's only a couple of pages long, and it's only a few paragraphs. So the forward, just what I mentioned there, the forward projections is essentially just a paragraph. What I'm referring to here is the FOMC statement, the most commonly talked about central bank meeting, which we had one yesterday, by the way. So as I said, this is the minutes offer a more comprehensive analysis of the statement and the talking points discussed in the meeting. Out of the interest rates decision and statement, you're looking for so out of the interest rate, you're essentially looking for market sentiment. So the direction provided by the central banks. This is what we are looking for, as this is the core of the trends in the market and obviously sentiment. The first 2 weeks of every month, or the first 2 weeks following the central bank meeting, for the central banks that meet every 6 weeks, sentiment or direction is usually pretty clear in terms of central bank sentiment, because it's really relatively fresh in investors' minds. So okay, so the reason the reason traders watch certain types of economic releases more closely is because in the central bank statement, the bank informs market participants what they are looking at going forward in their, as I said, their forward guidance. And this is generally only a very, very small paragraph in the statements. So as the weeks progress, following 2 weeks, as the weeks progress and we close in on the next central bank meeting, previous sentiment tends to fade, and traders begin attempting to guess or forward project, guess the next sentiment of the central bank. So an important point to remember if you're considering trading central bank meetings is it's not the same as trading an economic indicator, as there's a number of variables we have to take into account. For example, the FOMC and the ECB both have press conferences 45 minutes after they release the statement. And it is here that the heads of the central banks, so President Lagarde and for the ECB and Powell for the FOMC, it is here that price action can also see some exceedingly serious chop or whipsaws, as the press conference usually, if you look at the descriptions before, has unscripted answers, which, as you can imagine, can play havoc on currency markets and other financial markets, of course. So with that, if no change in interests is seen, trading could be better. I mean, better opportunities might present themselves following the press conference of about an hour, maybe even 30 minutes. While of course you may miss some of the moves seen during the press conference, I think overall it is better to wait, as the volatility will be too much for many traders to handle. So economic indicators. So this is where the economic indicators really come into play. So basically, as I said, the central banks piece together the economic data, and that's where they determine the statement or rate decision. So if we see big economic numbers form around big key releases, and then that leads the central bank into the next rate decision. That leads the central bank into the next rate decision, sorry. And this is the reason why traders observe those high impacting calendar events so closely. Now, just to be clear here, I do know of traders, who focus largely on technical analysis and do make consistent returns without going into detail with the fundamental side of trading. So, but most of them that I've spoken to are aware of the general overall, the overall macro picture, and they are especially aware of the economic data due out each day from the economic calendars. That may affect their trading decisions on current trades in play, or that may affect, as I said, that may affect trading decisions. Now, just to reiterate, economic indicators or economic data are the drivers behind a large part of the currency markets movement, and this is what central banks also look at to make their decisions. So as most traders here, I'll likely use the Forex Factory's calendar. I have used this as an example. As I said, this is directed to newer traders, so please, anyone with experience, do bear with me, as I'm sure this will already be known concepts. So most traders will focus, as I said, on high impacting releases, which on Forex Factory are marked, as you can see, in red here. Orange, the orange colors, I don't think, there's one orange there. Orange there represents a potentially medium impact on the financial markets. Where's my cursor? There it is. On the financial markets, and yellow, of course, is a low expected impact for these events. We also have what's known as previous or prior, forecast, and actual. So previous, you'll find the previous values in this column here. Now, if you scroll up to the top of this this calendar on FP Markets on the Forex Factory, you will find that it will be labeled previous, forecast, and actual there. So it's pretty easy. But this column here represents the previous data. This column here, actual, so this is what the forecast is, and this column will give you the actual results, the actual results from the release. So forecasts, for those who are unaware, forecasts are generally a collection of economists' views, and these are then averaged, I believe. So Bloomberg, for example, will have their own forecast, as will Reuters, and other institutions work in a similar format. So new traders might also want to note that what the Q/Q or Y/Y labels refer to, and you'll see them at the end of the description, at the end of the economic data's description. You'll see them here, month over month, year over year, quarter over quarter. So as we can see with the New Zealand credit card spending year over year, all this means, the year over year, all this means is it's data compared with corresponding data from a year earlier. So don't be confused, but there is also what's known as the monthly year-on-year numbers in this case. So for the New Zealand credit card spending, this is for the New Zealand number will be the current one will be for January's year-on-year data. So this will be December's data, the year-on-year data, November's year-on-year data, as you can see here. And if you're unsure, you can look at the frequency of their releases. As you can see, it's released monthly, but it's a year-on-year figure, about 21 days after the month ends. So given it's released so long after the quite long after the month, the previous month ends, it's often given a low impact marker. So we have what's known as Q/Q. Look, I'm sure most of you guys know this, but and I will give a demonstration with the New Zealand the New Zealand CPI or inflation number, and that's, as you can see, is quarterly over quarterly. So what this is referring to is as you can see, it's the change in, it does actually say here, there we go, released quarterly about 18 days after the quarter ends. And all it is from each quarter. So it's the previous quarter's data compared with the current quarter's data. There's nothing really too technical with that. So it's essentially the measure of the number. I'm confusing myself here, I think, but I think you get the idea. It's the quarterly data. It's as simple as that. So the month-on-month measure is essentially the measure of the number 1 month to the next. You will also find some economic data on the calendars, which show Q/Y, and which is simply data that represents the quarterly data. Quarterly value compared with the same quarter a year earlier. There's nothing more to it. You will often find the Q/Y. This is not on the calendar, by the way, on the current example, but you'll find a lot of the Q/Y and things like that in China data releases, such as GDP. So, okay, on to the next one. So economic indicators, as their name implies, are statistics, often on a macroeconomic scale, and they're designed to measure economic activity. Traders and investors use these indicators to analyze the health or well-being of a country's economy. Government organizations and private groups release several reports on a weekly, monthly, and quarterly basis, each measuring activity in a particular segment of the economy. So widely followed indicators are, as you can see here, employment data, inflation data. So when I say employment data, you guys will probably be aware of the most popular one, out of the US Employment Situation Report, which has the non-farm payrolls number, which is widely followed. Then we have inflation data, so CPI, PPI, the Consumer Price Index. Then we have growth data, which is the gross domestic product, or GDP. And then we have obviously retail sales. We also have things, of course, like the stock market. This is a widely followed market for risk appetite. We also have industrial production to keep an eye on, and also housing figures. In terms of release schedules, approximately 5 key economic indicators are released each week. Of course, there could be some more some weeks. Now, no single indicator can provide a clear picture of the economy's health. At best, each indicator provides a snapshot of current conditions. But when piecing the economic indicators together, you should get a clearer picture of how the economy is faring. However, it's crucial to understand that some economic indicators are more important than others at certain points in time. Inflation, as of this presentation, is incredibly important. So other important indicators to watch, as highlighted in previous slides, can be found on these statements from the central bank in their forward guidance. They're essentially guiding you of what to look for. So what is the central bank watching? And this is what you should be watching closely too as you progress through your trading. So with everything we've touched on so far, we now have to realize that the economic data provides what's known as instant direction. The key point to remember, as I just mentioned, is the central bank informs market participants what economic indicators they are watching. So, for instance, if the central bank is paying close attention to inflation data and the CPI shows variance from the forecasted number, then reasonably aggressive price movement will be seen, and this can be traded. I personally do not trade the actual releases. I wait until the excitement calms down, maybe 15 to 20 minutes, and then look for potential trading opportunities using technical analysis as my entry technique. So what's important to note is that economic indicators create a short-term bias in the markets, but the central bank creates the long-term trend. So the best trading opportunities we can find is when these economic indicators, when these economic numbers are in harmony with the longer-term bias. This is not to say there are not short-term trading opportunities against the overall trend. You could also view weaker than expected data as dip by the dip scenarios. So with the Fed looking to raise rates, for example, a dip in price fueled by, say, weaker US data, therefore could be a nice opportunity to buy into the market. And again, this is where technical analysis can really come into play. And this is why I'm a big supporter of technical analysis. You can use TA to time your entries and essentially evaluate your risk profile via the chart. So with fundamental analysis, I think that's really, really difficult. It's not something I've ever looked into, but I prefer technical analysis to analyze my risk on the chart. So don't get me wrong. What I'm saying here is not simple, but it's certainly achievable and can really help shape your decisions. And ultimately increase your bottom line. So geopolitical events. Okay, so for the convenience of analysis, geopolitics events are simply divided into wars, conflicts, terrorist attacks, and international tensions. As you can see here, U.S. trade tensions from trade is a good example, and of course, a little closer to home for me is the Brexit situation, the ongoing Brexit situation. In other words, the UK exit from the European Union. Now, geopolitical events, geopolitical tensions can really have an effect on both fundamental and technical analysis. The announcements surrounding the geopolitical issues, as I'm sure you're aware, are usually not scheduled, unlike central bank announcements and the various economic data. And as I said, this really can cause havoc in the currency markets and can be very, very difficult to trade. There's almost no start or end to the geopolitical events. So just to wrap it up really quickly, so I look at three core components: the central bank direction, if you will, the economic indicators to provide instant bias, and then I will consider the geopolitical situation if it's present at that time. Following this, to aid timing of the market, just to repeat myself, we can then use technical analysis techniques to fine-tune our entries. So I have a question here. In data view, high impact, what should we do? Take a long or short? Thanks. In data view, sorry, I'm a little unsure of what the question is. Can you try and repeat that if possible? That would be great. So another question, do I use, okay, any more questions? Okay, I have a few questions logged from previous webinars. So they asked, do I use a fundamental analysis? So personally, I never used to use fundamental analysis other than being aware of the risk events on the calendar on a daily basis. But now I'm more aware of the central banks and follow economic indicators more closely. It is a work in progress for me, as I intend to really factor fundamental analysis into my trading decisions as I move forward. So I think combining the two offers the fundamental analysis and technical analysis offers a really great way of viewing market structure. We have one more question here. How much leverage is per unit? A euro dollar, for example. I'm familiar with CFDs. Does it work similarly? How much leverage is per, sorry, I'm not sure of the question. Euro. So are you asking what leverage is available for currencies? This is a question. Oh, okay, you are. Okay, so as far as I'm aware, for the retail account, now don't quote me on this because you would have to go to the support team to get receive more information. But for a pro account, you are eligible for up to 500 to 1 leverage, which, as I'm sure most of us here will recognize, 500 to 1 leverage essentially allows you to trade with smaller initial margin. So how you work that out is essentially divide 1 by 500, and that gives you your leverage percentage, which is 0.2%. So if you're trading, for instance, a 100,000 position, standard lot in a currency market, all you have to do is put down or deposit. Your deposit margin is $200 US. The reason many educators say to be wary of high leverage is because it can tempt uninformed traders to trade more positions. Because as you can imagine with the example I just gave, if you're trading with 500 to 1 leverage and all you have to do is put $200 down to control a 100,000 position, what this does is tempt uninformed traders to trade more. So it just, and all of a sudden you're in a position that's just incredibly risky. And how does it work? Sorry, I'm really not sure. As a use a rudimentary number. Did I just answer that? I'm unsure. So just let me clear that. Oh, I answered it. Okay, excellent. But just to reiterate, with the pro account, you are, I believe you are, but you'd have to check this with our support team. You are eligible for 500 to 1 leverage, but you can also, if you're a retail investor, you have access to 30 to 1 leverage, I believe. Now, I personally, I'm fine with the 30 to 1 leverage, to be honest. I know that you would have to have a larger, you would have to have a larger account size, of course, to accommodate the initial margin. Micro units, there's a question here, micro units. So we have micro, mini, and standard lot. So the micro units are essentially 1,000 units. The mini is 10,000 units, and the standard lot, of course, is 100,000 units. And this is all of the base currency of the currency pair you're trading. Which time frame is perfect for technicals when trading? I wish I knew. But for me, I do like, over the years, I do like micro. Yes, micro is 10,000. You're correct. No, micro is not 10,000. That's incorrect. Sorry. I'll get back to the previous question, but there's been a comment in there saying micro is 10,000. Micro is not 10,000. Micro is 1,000 units. Mini is 10,000 units. So which time frame is perfect for technicals when trading? There is no perfect time frame. So I've been looking at the charts for years now, and there is no perfect time frame. What is perfect is something that's it's trader dependent, right? So it's something it's something personal to you. So for me, I do like the H1 time frame, but I do also look at the M5 time, the 5-minute charts as well, to sometimes pinpoint my entries. Other consistently profitable traders I've spoken to are very skilled where they can trade either the swing trading time frame, so the H1, the H4, maybe even the daily time frames, and also scale back down to the lower time frames to essentially day trade. Is there a tool similar to stock scanner in Forex to predict possible large movements in Forex? And I'm not sure, Mo. That's a good question. In Forex, is there a stock scanner? So when you say stock scanner, are you looking at performance? It tells you which so advanced decline indicator or something like that. Is that what you're referring to? I'm unsure. The next question is, did you record the webinar? Yes, as said at the beginning of the presentation, the webinar is recorded and will be available on the main FP Markets website under resources, or alternatively, just shoot over to our YouTube channel and you'll see all the previous webinars there. Okay, I'll just have one more question from this was a previous webinar. What websites can I look at for fundamental analysis? So this was a really good question that I thought would benefit some of the traders here. So for us personally at FP Markets, we have a daily fundamental analysis report, and you can check that out under, again, resources, I believe, and you can find that. Oh no, sorry. Yeah, you'd have to go to the research section on the websites to find that. So I personally also use Bloomberg and Reuters and the Financial Times. They provide timely news. Also the Twitter feed is awesome for news updates. If you follow the right people and organizations, it provides a continuous feed of news for you. So instead of, for instance, looking at the Forex Factory calendar, if you follow the right people, when you're on Forex Factory, I did it when I was first training. You're clicking on the refresh button, and all of a sudden the market's moved already, and just if you follow the right people on Twitter and the right organizations, the news is almost automatic. It's so fast. And this is something I would recommend. So create your own tweet deck and find and follow the right people. So is there an old webinar that steps through Forex trade setups and example? So I trade CFDs risking 3%. I have a spreadsheet that shows me my margin, max loss, and win. So I'm aware of the trade. Need to do the same for CFDs. I'm not sure, to be honest. You'd have to look through the previous webinars. We've presented quite a few, and we've used. There's been a number of presenters, so you'd have to look through that. There are some. We have some live trading sessions, if that's what you're referring to, and you can look for those. That was mainly produced by my colleague. So yeah, please do look for that. I have one more question as well. This was again from a previous webinar. So how to understand more of the central banks. So I have a few links if you're interested. I'm going to throw them in the chat box. Just give me a second. Just find these links. Now, this link is let me just. It offers you plain English of how to an introduction to the FOMC. So do look at this. Really, it was really interesting. I found it really great to read. And for helping to read the FOMC statement, you know, this other link is a fantastic read, and this is something I would highly recommend looking at. It's quite detailed, but it's in simple words. You don't have to be an economist to understand. So do look at these these links I've just put on in the chat box, and they can really help you understand what some of the economists are talking about. So we have one question in the Q&A box. Most of these were in the chat box. So the economic calendar may ruin ongoing FX trades. So how to handle this problem if one is unfamiliar of its effects on trade setups. So if you're unfamiliar of its effects, you shouldn't be trading live. That would be my first, you shouldn't be trading with real money. That would be my first comment to that. Not you personally, I'm referring I'm just generalizing here. So I would not be trading with live money if I did not understand the effects of the calendar. You should always be aware of the economic calendar or what's coming out, what could potentially affect your ongoing FX trade. What I do is if I'm in enough profit, what you can do is reduce risk to break even, right? You can move your stop loss to break even. You can move your stop loss to break even, take partial profits. You can even liquidate the trade if you believe that there's a chance that it could turn out unfavorably. Now, there is a clear memory of mine when I was trading a few years back, and I was trading the pound dollar. I can't remember what the economic release was, but I was in a trade. It was a large position as well, and it haunts me to this day. So I'm in a trade, I'm long, and I can't remember. I think I didn't even reduce. You know what I did? I moved my stop lower. So I'm long at a certain point, and my stop is, say, 20 pips below. So what I did was, because I thought I understood what was going on, I moved my stop lower to accommodate any whipsaw. What happened was, as you can imagine, price jumped below my moved stop. So I lost an incredible amount of money in the space of a few seconds. And that really opened my eyes to how powerful this market is to the uninformed. And that's when I really began focusing on, my trading mindset and the way I approach trades and things like that. So to answer this question, if one is unfamiliar of its effects on trade setups, you should familiarize yourself with the effects of economic events before considering live trading. We have a question: how much is each pip? Now that's a good question, but yes, no problem for that question there. So look, how much is each pip? That's a really difficult question to ask. How much is each pip on what? Euro, dollar? What's your so to calculate pip value? And this is something as well, guys. You should really any currency. See, that's not some. See, if you ask someone how much is each pip, any currency, it's a very difficult question to answer, because look, guys, if you want to become consistently profitable traders, not only do you have to understand technical analysis and fundamental analysis, you need to understand how to calculate pip values, how to calculate your margin. Don't rely on calculators. Do not rely on calculators. But you can. I want to reiterate that. I want to repeat this. So don't rely on calculators to. When I said, I do use calculators at times, but I understand the dynamics behind the calculation as well. So you should not always trust these calculators. You know, you should understand the dynamics of how to calculate. Look, calculating pip value is very, very simple. Let me just quickly run through it. So if your account currency is the same as the quote currency in your currency pair, all you simply do is you work with 10 cents, $1 and $10. So 10 cents or 10p for any British here is it represents a micro lot. Then you have the mini lot, which is $1 or £1, and then you have the standard lot, which is $10 per pip or £10 per pip. If your account currency is the same as the base currency of the currency pair trading, what you do then is simply divide the pip, so 1 pip, 0.0001 by the exchange rate, and then multiply that by the number of units you're trading. So that could be 100,000 units for a standard lot, and that will give you your pip value in your account currency. What about if you're trading an account currency? Sorry, a currency pair that has no relation to your account balance. So. Sorry, your account currency. So if you're trading the euro dollar, but you're trading, you have an account denominated in Aussie dollar, all you simply do is swap the euro, move the euro out of your currency pair, place the Aussie dollar into the base currency, and simply compute the same calculation as you would for the base currency. So using the Aussie dollar, you would 0.001 divided by the currency pair, the Aussie dollar currency pair, and then multiply this by your units traded. So your units traded could be 10,000 units, 100,000 units, 15,000 units. So 1 mini lot and 5 micro lots. So I've just explained how to calculate pip value there. I hope that helped the question there. But the same is for margin. Margin is very simple to calculate as well. But as traders, we all need to know this. We all need to understand this. It's not just simply picking a place on a chart and praying that it works out. You're trading against very, very intelligent individuals that spend years and years studying this. So you really need to put a lot of effort into this so we have a comment here. Thanks. That was a lot. Yeah, I'm sorry. That was a lot. Where can I read to step through it? This is awesome. So look, I can, I think we have it in our research, a video by me actually, where I did go through that. We have it in our research and education, in our education academy. It's currently being built, and that will go through it in detail. But look, this will be recorded, and do go over this if you need. Look, for margin, I can tell you now. So if you want to understand how to calculate margin, just watch the recording. So for margin, if you want to calculate your margin and your account currency is the same as the quote currency, what you do is you multiply the position value. So this could be 100,000 units for a standard lot. You multiply that by the exchange rate, and then multiply that by your leverage, your margin percentage. Okay, so that could be 100,000 multiplied by 1.2000 multiplied by 1%. Because remember, your margin is found by dividing, your margin percentage is found by dividing your leverage ratio, 1 divided by 500 if you're working with a 500-to-1 leverage account. Now, if you're trading with an account currency similar to the base currency and you want to know the margin, all you do is simply, with this case, is very, very simple. So if your account currency is the same as the base currency, all you do is you divide the leverage ratio. So if your account is set by 500-to-1, simply divide 1 by 500. That will give you 0.2%. Now that's all you work with, and that's all it is. And yeah. So look, I've gone into too much detail here. It is a lot. I apologize. And look, just to finish this off, if your account currency is not the same as the currency pair traded, this is for margin again, all you do is simply swap your account currency for the quote currency of the currency pair traded. So again, if you're trading say the Aussie US dollar, but your account is in euro, so all you do is you swap the US dollar for the euro, and then work by the same way as calculating for your quote currency. The same way as you would calculate for when your account is the same as the quote currency. I'm sorry about that. I know it's way too much. I know. What is the best way to reduce risk on fundamental analysis? Now, if you remember, I did say in the webinar, I don't really look at that kind of thing. I would always use my technical analysis, my skills with the charts to assess and evaluate the risk. Okay, so there's no more questions, I think. Right, so unfortunately, that's all we have time for today. I sincerely hope some of the newer traders were able to walk away from this presentation more knowledgeable, as I always say. So as we move into February, here's what's on the horizon in terms of webinars. So we have support and resistance, the basics. This is back to technical analysis, and that's on the 3rd of February. Next up, we have an introduction to technical indicators, and that's on the 10th of February. The 17th of February, we're looking at what an economic calendar is and how do traders use it. So we'll be touching on some of the concepts we touched on today. And then finally, on the 24th of the month, we'll be looking at the wonderful world of trading psychology. Now, just a note, the times will be changed going into February to 11 a.m. GMT going forward. As always, if there are any topics you would like the team here to cover, please consider sending over an email to either the support team at support@fpmarkets.com or Markets Analyst at fpmarkets.com. So the Market Analyst email, as you can see here, is the direct email to me and the research team. Also, do make sure to register for the FP Markets Telegram channel. You'll be able to get instant updates from that point. Right. So on that note, thank you all so much for taking the time out of your day to attend the presentation. As I said, I really hope it was beneficial and you took something away from it. Have a great day, and I'll see you all again very, very soon. Thank you.